right, good morning and welcome to our latest episode of Know Your Worth. Very special welcome to our guest this month, John Orsini. John, thanks for joining us this week. We really appreciate it.
My pleasure.
This has been one we've actually had circled for a little while as a want to have, because we had your coworker and peer Rob on like a year ago. So I think between the three of us, we actually texted at one point, like, we're going to see who does better on this show.
Well, that's a high bar.
Rob was actually laughing because I think in the follow-up to that episode in LinkedIn, I tagged him as the effervescent Rob Mador, and he goes, nobody's ever called me effervescent before, so I'm going to have to up my adjective game for you once we get over this. Mike, good morning, buddy. How are you?
I'm doing fantastic. I'm ready. To chat.
So, John, I think we're going to dive right in. I want you to introduce yourself, introduce your firm. Obviously, some brand new news coming out about your firm, so some exciting stuff to sort of share with the audience. And then I'd love to start really high level with just explain a little bit what an investment bank is and does. Most of our listeners are not super well versed in what RIA or wealth management M&A is. So just give us a little bit of background on yourself and your firm, and then we've got a bunch of follow-up questions for you as we get into it.
Sure. So my name is John Orsini, and I'm a director with MarshBerry. I work with wealth advisory, business owners, leaders, and private equity firms to help them realize their objectives. That can be through strategic planning and consulting, generally we'll think about it through financial outcomes, so not necessarily operations, but more towards trying to figure out the direction that the business will go and to figure out the strategic options along the way, whether it's a debt or equity raise, seeking out a strategic partnership, or doing acquisitions themselves.
Yeah. And I think that some of the private equity background or equity raises like that, there's a great example of where a banker is going to differ significantly from just a traditional sell side advisor, right? Like, you guys are involved in a lot more than just the simple help me find that new partner, introduce me to them, prepare the financials, and then get out of the way. You guys do far more and are involved in a lot more of our space than just that.
That's correct. So we don't show up with the end in mind. So we build relationships over long periods of time with business owners, and our thesis here is not around some particular end, but rather to say, what is it that you're looking to achieve? And most people have a pretty clear idea, but they lack context. So what we bring to the table is a broad perspective of the options that are available. And then I think the MarshBerry team in particular, we have the ability to what we say, look down the road and then around the corners. When I say that, I mean, what does the future hold if you were to go down this path? And what are some of the consequences, positive and negative, that you could run into as a result of doing something? Whether it's deciding to retain the equity 100%, getting equity into the Generation 2's hands, and then kind of everything in between.
Yeah.
John, I'm curious. So at what stage are you typically when does that relationship start with those advisors? Because it sounds very similar. You know, we've talked on this show where Michael and I differ. You know, Michael's on the new to Carson side. I work with the existing partners. Very similar for me. My relationship with our advisor starts when they join Carson. And then very similarly, I'm kind of helping them along the way. I'm helping them do their own deals. I'm helping them with a minority transaction when that makes sense. I'm helping them get equity to those advisors. And I think to your point, I think that's a very important point to hit on is the earlier you start that relationship, if it's not just, hey, I'm coming to you right at the very end for this deal to sell, you can help them evaluate all those paths. And the earlier you're having that conversation with them, I think the more paths actually open up to those advisors. And then you have more options on the table if we're talking 10 years down the road, 5 years down the road versus, you know, I'm looking to sell right now and I have kind of this in mind. So speak a little bit to that on kind of when do you typically start that relationship?
Sure. So I think that's a particular benefit that MarshBerry brings, and probably a differentiator relative to others who are doing similar things or somewhat similar things in the space. So when I say that, I mean, MarshBerry is north of 100 million in revenue. We're able to take a very long view. So there, in any given year, any one particular sale isn't going to make or break MarshBerry's year. So that allows us to take that long view and to work with clients and to really be objective and to sit back and let them take time to digest and work through what their strategic options are, so that when it's time for them to do something, whatever that is, MarshBerry has a solution for them.
Yeah. It's Mike, your question too around timing, like that is that seems to be a theme. So, John, we just got back from our Excel conference in Phoenix this week. We were there Monday, Tuesday, Wednesday this week. And we had conversations with a few advisors. And one of the questions was around getting equity or some level of ownership into the hands of the second generation. And that timing equation becomes so critical, especially for an advisor that is maybe at the tail end of their career. And realistically, like the math gets a little bit tough if you haven't planned for this appropriately. And now you've got somebody in their 40s that's got a mortgage and kids and cash flow needs trying to buy a business that, may transact for tens of millions of dollars. And that debt load just becomes sort of unmanageable. I mean, I'm sure you guys are seeing a lot of that, which is what's prompting some of those conversations.
Absolutely. So I would say the majority of our conversations begin with a business owner who has had quite a bit of success. They're at some level where they're kind of at an inflection point, or we'll say in that step function, and they're contemplating, do we continue to grow and invest, or do we seek out some different strategic partnerships? And concurrent with that work, as we're doing it, we begin to look at the teams. And then obviously there's going to be the Gen 2 who is in place, who is interested in doing something. And I think generally the ownership is very interested in doing things as well, but they don't fully understand the gap to value. Yeah. So the value on an external basis versus internal is quite steep. But generally speaking, when we're working with these firms, if they have a longer time horizon, we say, let's just take bite-sized, digestible chunks. So there's no need to try to transition 100 or even 50 or even 25% of your firm in any quick period of time. Rather, let's work with something 5 and 10% range. Let's get the equity, the path to partnership plan in place. Let's decide which types of vehicles you're going to use to deploy, and then go from there. And let the advisor continue to grow in a way that makes sense for both the business and for them personally, because let's be honest, it oftentimes involves more than just the advisor. There's a spouse, significant other who has to sign on for things if you're taking an additional loan or putting down your own personal capital to acquire a percentage of the business.
Yeah, that's great. And it's vital too, if they do end up maybe approaching the larger market and working with an institutional buyer like a Carson, getting that equity into the second generation's hands well in advance, because then obviously we love to see that. I would argue, I think Mike, you'd agree with me, like that firm is more valuable to us if there is second generation ownership, because there is some alignment, and then we know that they're going to be able to roll that equity over into a growth stock like Carson, and they're incentivized and behave like an owner.
Completely, yes.
Yeah.
That tie as we go into the next phase of that after they've come on board is having that next gen, have that equity, have the rollover equity as part of it, and having that have been the plan for several years before, and not just kind of a surprise at the very end. What I've seen is typically they're already in that owner's mindset, because it is a different mindset, right? The owner's mindset, I think sometimes if on the younger side of advisors, they see it as the financial aspect of it, right? Making more money as the owner, but the other sides of being owner, the risk that comes with that, right? When there's downturns, the owners eat last kind of mentality. And so those sort of things, the earlier I've seen that next generation of owner have ownership prior to the deal, the more they act like that owner post-deal, it helps with the growth rate, helps them achieve retention and growth and all those components as well.
Yeah, John, I'd love your input on this, because I'm guessing from your side, they approach a transaction differently and from a different mental headspace if they're an owner too, not just for the financials like Mike's talking about, but you're able to maybe take a more strategic approach to the market if you are equitized and you're on the cap table and you're maybe sitting alongside the G1 as they approach the market.
Yeah, that's correct. So it depends on where the firm is in their arc. So obviously I think our preference would be to have as many of the key personnel holding equity as is possible. We don't view that as a necessity. So based on where you are and from a timing perspective, it may not make sense. Mm-hmm. So, but when positioning the opportunity with prospective buyers like Carson, we spend a bunch of time clearly identifying who the key personnel are, what that G2 looks like, and then when matching up with prospective buyer, what are the opportunities that it brings in the future? And that's one of the things that we spend a whole lot of time on, to be quite honest with you. And it's the thing that really appeals to me in this marketplace. Is a bit of background on me. The group is definitely not familiar, or the audience for sure, is that I led M&A Nationwide Investment Management for about 8 years. and that was around consolidation of mutual funds. So from a mutual fund perspective, there was a lot of, we'll say synergies that took place. That's not necessarily the best thing, but there's a lot of redundancy that was flowing through that space. Many large cap growth funds that weren't necessarily differentiated. So there are some transactions that needed to happen. On the wealth side, the thing that makes it most appealing to me and making the move over from being a buyer like you, Michael, to being an investment banker was to be able to work with firms to find solutions, not just for themselves monetarily and their clients, but then also opportunities for their talent. And we've had many conversations over the years, Michael, around who are the people. This is the biggest thing. The revenue's there. The market takes care of itself. I really want to dig into who's that Gen 2. Who are going to be the future leaders at Carson, and let's try to make it an exciting offer for them as possible.
Yeah, isn't that that is really one of the most personally gratifying things about this is that so much of M&A, I think in the broader scope of conversation, just in the corporate world in general, it involves exactly what you were talking about, just redundancies and synergies, which means people losing their jobs, frankly. And in this space, it is such a talent acquisition play. We are creating new career opportunities for brand new teammates of Mike and I, that they're coming in and they're stakeholders like we are. And you're starting to see just this explosion of new capabilities and talent. I mean, I'll just give you an example. We partnered with the Sweet Financial Office a year ago, just a high growth, really sophisticated firm. And one of their really talented operations professionals is now on our integrations team and running some of these integration meetings, including a deal we're working on together right now. So we've been able to see some of these folks just really kind of build something special and expand outside of maybe the local community they were already part of and say, hey, I've always had a desire to do M&A. I've always had a desire to do marketing, or I want to be an advisor. And we're able to provide a little bit more opportunity for them that maybe they didn't have access to in the past.
Yep, that's exactly it. So from a relationship perspective, our conversations tend to start off early stages where we're working at the highest level, and they begin to kind of fold out exactly what it is they think they're looking to do. Any prospect that I work with, I'll say, hey, as you're thinking about going to market, you're focused on kind of the first 5 variables. And then in reality, the decision is ultimately made in variables 10 through 15 or even 15 through 20. And oftentimes what that means is really contemplating what it means specifically for their team. Most business owners have really only done that thing. They've operated in their own ecosystem. There's this level of comfort and security there. And with change brings uncertainty and a little bit of angst potentially for the team. Where when working with firms like Carson, we really lay out, hey, this is what the future can mean for you, not just from a resources and capabilities perspective, but then also from a career pathing perspective. And that oftentimes is this thing that gets people very motivated and excited beyond just the money and the equity and all those things. It's like, I want to work or need to work for another 20 plus years. I want to be at a place where I can continue to grow and not stagnate. Firms like Carson bring that to the table first and foremost.
And I see it as such a fine, delicate balance too, because in our space, it is truly a relational space, right? That relationship
100%.
Between the client and the advisors, the client and the rest of the team, when they come into the office, who are they seeing those faces? I like to kind of look at M&A and other spaces to just kind of see what it's looking like. And YouTube is actually a very interesting space right now. The big YouTube channels, we have a lot of investors going in and seeing, there's a lot of revenue in those channels. There's a lot of space to come in and invest in these small channels that have grown to be massive. And they're true organizations at this point. I mean, some of these channels have 50, 75, 100 employees working for them. But what's interesting is as they've come in, you've seen a lot either fail or succeed. And often that is driven by the investor coming in and thinking that the content is what those people watch for, where the views come, where the ad revenue comes from. And they put less weight in, no, it's the talent on camera. Those people develop a relationship. They come back to watch for that person on camera. They're not necessarily maybe totally tied into the content. They can go anywhere for the content, but what's on the video, it's the relationship, it's how that person presents it that's really the driver there. And I see that it's been a fun kind of look into that space because it kind of does correlate into our world as well, where the value is in that relationship with that person. Those clients can go anywhere and oftentimes get similar levels of service, right? Maybe not the fantastic service, but it's that relationship they've built. So I find it very interesting. I think the focus on the people, to your point, John, it's very important in these transactions.
I couldn't agree more, and I'm going to compliment the Carson team here. in particular. So when I started the M&A program at Nationwide, I went to the Wharton School. I took the executive M&A training. A few things, you learn a lot, but you walk away with just a few things. And first and foremost, it was how to clearly define investment thesis. That is, what is it that you're looking for and why? And then why would somebody want to come and partner with you? And then secondly, have an adaptive process in place. And we've had this conversation over the years. You're not going to know it all at first. Learn from each transaction. And then from there, refine. Never take more than one deviation away from what that thesis is, because then risk increases. So the thing that's been most eye-opening to me is just the high quality of the M&A teams, the diligence teams, all the folks that are bringing on new partner firms, the clarity around what it is that they're looking for, the rationale and why and how those things plug in is the thing that gives me the most comfort when operating in this space. Having that, again, that moment of you have independence, you have this thing that you built for 20 plus years. These are not your clients. They're not clients. They're friends. These are oftentimes their best friends. They travel with them. It's like this family environment. And going to a partner firm can be scary. Having the well-defined process that I see at firms like Carson is the thing that makes me so comfortable with making the recommendations to go ahead and move forward. And then to see as they're growing, learning through the diligence process and onboarding process. And then when we catch up a year plus down the road to see the success that they're having, it's just very fulfilling.
Well, I appreciate that, John. I'll tell you that discipline and having the thesis, I think that's the hardest part, in my opinion. I think a lot of firms, it's tough, or let me rephrase it. I think it's easy to be really aggressive if you've never done a deal. And it's easy to sort of sway from that thesis when you're trying to get the first deal across the line. I think it's even harder when you start winning and when you start having a few new partners join and select and the machine gets running. It's even harder not to take a swing at everything because you kind of feel like you got a hot hand. And remaining true to who you are and bringing on the right firms, I think that's a challenge. And I think we've seen some of our competitors in the space, people that have blazed this trail before us, and we're trying to kind of learn from maybe some of the pitfalls that they've had and some of the wisdom that they've shared in some of the industry events that you and I have been at together. I'm gonna turn it back to MarshBerry because I'll compliment you guys. I think it's culture is such a buzzword. I think everybody kind of says, we lead with culture. We lead with culture. But in reality, a lot of times they're running an auction process. And we have one just yesterday. So you get a SIM in the email that says, here it is. Please submit the response. In this particular firm, it was like, we're not going to give financial data, and we're also not going to answer any questions on the SIM. And it's really easy for me to take that and slide that to the bottom of the pile and say, pound sand. We're not going to allocate millions of dollars to somebody we know nothing about. The way you guys sort of hone in on that, whatever it is, like the Elite Eight or the Final Four, or the top 10, it doesn't matter, but that you're bringing that universe down to a subset that makes sense. And I think it's brilliant for a couple of reasons. One, it makes us fall in love with the prospect. And going back to Mike's comment about this being so personal, it is, there are days of falling in love and there's days of heartbreak. And sometimes that heartbreak is really tough, but it's because you are bringing folks to the table that we know are going to be a fit for us before we even get on the phone. So we're going to come prepared. We're going to bring the talent. We're going to make sure that we show up well and have those conversations and try and get to the heart of what they're looking for. And I think you guys, better than the vast majority of folks that cover this space, because there's 60 banks and folks that do sell-side advisory. There's maybe a much smaller subset that do this at any sort of scale, but you guys really do put culture first, and I commend you guys on it. And that's true for all of the managing directors, because there are other banks where maybe one does lead with culture and somebody else on the team doesn't. I mean, you, Kim, Rob, everybody is a true professional. There is an approach here that makes sense. And I told Rob actually in a prior conversation, even the SIM documents you guys prepare, there's a through line that makes sense. The thesis around why they would be looking to transact and why they'd be looking to transact with you makes sense. And we have less questions, frankly, on a MarshBerry lead or client than we would at some of your competitors because of the way that you prepare that and lead with culture first. So kudos to you guys. I mean, any firm that hires you is going to be well represented, and we really mean that.
Well, Mike, thank you for the kind words. And I have to say, this is a tribute to MarshBerry and their founders. We've been around since 1981, so I did not come up with this. But what I can say, it is the thing that attracted me to MarshBerry. When I was contemplating continuing down the asset management path or shifting over into investment banking, the thing that attracted me most during those conversations was the approach that MarshBerry took in going to market. And when I say that, I mean not broad auctions. So sitting in that seat, I learned very quickly at Nationwide that if I showed up with a teaser and limited information, I didn't get a lot of backing from the finance group. I couldn't get the backing. When I had a relationship with the bankers and I had a lot of clarity and depth, and I could then plug in this opportunity into Nationwide's Big Five initiatives, I got a lot more buy-in because all the stakeholders were willing to sign on because they could see immediately how it would connect. So when having those initial conversations with MarshBerry, is we don't do broad auctions. We like to go to 6, potentially 8 firms through the process. It's going to require you to do this, John. You'll need to build relationships with all major acquirers in the space, learn very intimately what their process is, what is their value proposition, how does it differentiate from the others, and then maintain that relationship over time so that when it comes time to represent a firm, and I'm with them already probably for 12 to 18 months, when we get to the buyer selection process, that's easy. At that stage, I have a very good handle on what they're looking for. We make the recommendation of about 12. We winnow it down to 6 to 8, and then we do the virtual meeting process. All the buyers that we work with through that process, they know that they've been pre-vetted, that they're there for a reason, and they have an opportunity. It allows you to get very focused and excited about the opportunity. And look, if it's not going to work, that's fine. That's why we bring it to more than 1 or 2. We bring 6 or 8 because we understand. But the reality is when we go through that process in that manner, it makes it much more efficient for everyone involved. It allows the buyers to be, I'll call it selectively aggressive. So when you see that opportunity, you can go very strong for it because you're going to know that you have that opportunity to win the transaction.
I totally couldn't agree more. And that conviction, I think a lot of sellers probably don't know that the way that this process works, obviously, is, we would work together. We would get that SIM deck after we sign an NDA. We create our own valuation. And then we have to go win approval internally. So Mike or I, one of us is going through a process to get approval on that valuation. And then ultimately, once Q of E comes back, we've got to then go to the board and make sure that the board is still on board. And when we have conviction and we can say, not only do we feel convicted about this particular opportunity, but we feel really convicted about their representation, that makes a huge difference. Like, that process is by no means rubber stamp, but it is a lot simpler when you've got multiple people internal on the buyer side that's singing the praises of a MarshBerry and a John Orsini. So you've done it right, for sure.
And from a seller's perspective, if I'm looking to truly find the best fit for me and my firm, right, where am I going to succeed the most, and the best deal terms I can get, I want to work with a firm like MarshBerry who represents me in the best way to those potential buyers, right? To your point, Michael, when we go in and we have to get those approvals, having all of that information at our fingertips, truly understanding the fit and everything, allows for us to be more successful in that process, right? So the difference between how you represent those sellers makes a huge difference on the success. And to your point, Michael, like if we get that SIM that has really no data, throw it in here, I mean, it's not going to lead to buyers having a good time on our side. So I think that's a key point from a seller's perspective on why understanding who you're utilizing and who you're bringing onto your team really does matter. And it's going to lead to a better deal.
Yeah, so I think all great points. When running a process, the thing that we begin with when we meet as a team internally at MarshBerry is we're going to go deep, we're going to be in depth, and we're going to build a pro forma that is an accurate representation of the business historically and where do we think it will go forward. Our motto is you want no surprises. So we want to be upfront and transparent with everything. Bad news does not get better with time. The last thing that we want to do is put a partner, and we're not partners in the literal sense, but figuratively, we are partners with all the buyers in the community. And the last thing that I want to have happen is for them to be in a position where they are perceived as having retrading the deal.
Yeah.
That's a failing on the banker just as much as anyone else. I'd say probably even more for not doing the work up front. So we spend the time to ensure to the greatest extent possible that we can get to the finish line in a great way.
Yeah, you're talking about bad news doesn't age well. You guys ever read Eat That Frog early in your career? Nobody? Oh man, it's like a classic book. It's you eat that frog. Like that's tackle the things you don't like to do first, and a lot of times that's confrontation or bad news. But I got my daughter saying "eat that frog" now, so she knows. We always go for those bad news first. I think that forthright communication leads to optimal outcomes, and more often than not, we're worried about having that conversation much more than we should be. And we can find that by just having that forthright conversation, usually you put stuff to bed pretty quick. All right, John, so let's talk about PE money. So I talked, Mike and I were having a conversation in the last episode about the article that you were quoted in. It was a great article. It started more around just the valuation you see is not always the valuation that's there, kind of look beyond just the headline. But you had mentioned the flow of PE money sort of forever changing this space. And I completely agree with you. Laura Delaney from Fidelity and I did a panel on this 3 days ago on this exact topic. And we were having a conversation. I would argue that in many ways it's professionalized the space, but I'm interested in your thoughts on the continued impact. And then I want to bring up an interesting trend that Mike and I have seen and ask if you've seen something similar and maybe what ramifications might look like for this industry go forward.
Sure. So again, the benefit of coming to MarshBerry. So we follow the private equity money. So MarshBerry began in insurance brokerage and distribution, and in the 2010s began to see increasingly the number of deals we were participating in that had retirement, 401k, wealth advisory businesses as a component. We talk about that in a lot of the content we wrote a few years ago around industry convergence. Mm-hmm. The thing that the private equity capital has brought, they've learned a lot through insurance brokerage, and there are a lot of similarities as you think about those businesses at a 30,000 foot perspective. And when I say that, what I mean is that you're working with individuals almost primarily to help them on the insurance side is to kind of mitigate risk and protect the liability side. And on wealth, it's on asset protection, long-term growth, so that they can achieve whatever it is they're looking to do in the future. The model of recurring revenue is not lost in either of these spaces. So private equity sees that, and they realize that by making the proper investments, they can do things that will help the client, not just today, but in the future, in terms of increased capabilities and services that are made available to them. They have the professionalization from running the M&A programs through the insurance brokerage firms and the experience that they've had there, and they folded that into, in many cases, not all, into the wealth advisory space. So from there's a lot of confidence that they can continue to replicate, and that's why there's no shortage. So what we find when we're working with firms and the 500 million to $1 billion, not necessarily the ones that I'm speaking to now, it's more of those 2 to 3, 4, or 5 billion AUM firms who may not be looking for an outright liquidity event or to be acquired by a larger firm, but they have a management team in place, they have a perspective, they've had success on a smaller scale of M&A. They're saying, we want to do this in a very significant way. We want to be the Carson group of the future. How do we do that? Well, there's a lot of private equity investors who are ready, willing, and able to do that. When they're investing in high quality teams, they can bring the expertise that those teams need to continue to execute on the things that have made them successful at that point, so they can supersize their returns as well.
Yeah, and you actually kind of already got ahead of the question that I was going to ask, or the follow-up is, this is not a pejorative statement, but historically, private equity has referred to sub $10 billion firms as sort of subscale platforms, as smaller platforms. Most of the large sort of New York 10 were kind of looking for the larger platforms that they thought they could really drive outsized growth. But the definition has changed. I mean, now to your point, new players have entered the market, and you have seen a lot of these $3 to $10 billion firms attract private equity money and investment. And we've actually seen some sub-billion-dollar firms not from a Bain or a Carlyle or a Citadel, but these much smaller, more local pockets of private equity that are investing in an RIA. So the word has sort of gotten out that this isn't just a play for the gigantic pools of capital. This has been a play for some of the smaller, more local pools of capital. And I find that fascinating. I think it's healthy for our industry that people are willing to invest, and that a sub-billion-dollar firm can get an investment from a local private equity firm. But it's not something I would have predicted 5 years ago.
Yeah, so I think there's a couple of factors at play here, and I'll speak to both of them. So kind of historically, I think everyone acknowledges the fact that, the data is there. The average wealth advisory business owner is 60 plus years old or whatever that number is. They need to do something. They need to find a partner. We're going to rate this year probably 400 transactions in the M&A space that we produce content, quarterly reporting. We're well on target for 400 transactions. That is a fraction of the transactions that actually take place, because we're only reporting on 100 million plus and publicly announced.
That's exactly. Fidelity does the same thing. Yeah.
Yes, well north of 1,000 transactions will take place this year, and it's really eye-opening when you're working with the 6, 7, 800 million AUM firms and just how acquisitive they are and the number of things that are happening. The thing that's appealing here is that I can say today, with the number of quality buyers in the space, that I truly believe there is something for everyone. The thing that I'm finding as we continue to go down the path is just the number of firms who are more interested in going with something smaller. They want to take on more risk. They want to be a part of something, particularly as you think of, maybe advisors who are on the younger stage or they have a relationship in market already. They're looking for something there. So when they go to market, they prefer to go as a $2 billion AUM firm, rather their 250 and the other 500 of the firm is partnering with them. So you see these opportunities to kind of incubate and build along the way to arrive at something that perhaps has a little bit more meaning and impact in the market.
Yeah, and it's basic investment rationale too, right? I mean, you have a chance for outsized returns by going to a smaller firm and taking equity when they're earlier in their career, and you take on more risk by partnering with a smaller firm. But I'll tell you, I mean, we have some competitors where that thesis has proved to be extraordinarily strong. And look at what Jason Gordo and Gary Roth have done at Modern over the past 2 years. I mean, from zero to probably 10 billion here in no time. I mean, there have been a few firms that have done this really, really well.
Yeah, that's
sorry, go ahead, Mike.
Well, I was going to ask what you guys have been seeing. So it seems to me, from my perspective, but you guys have a front row seat at this. It seems like there's a little bit more of a prevalence of the kind of this third type of advisors. So I always thought, there's the type of advisors who they are at some point going to sell their firm when they're looking to retire. They've built up a good firm, passed it on to somebody who can take care of it. Right, true succession plays. Then there are, and this is kind of the pool I play with, there are the advisors that say, I want to keep doing what I'm doing. I got a good group here, I want to do what I'm doing, but I want to attach to something bigger, right? I want to join something bigger. I want to leverage those things, whether it be capacities, whatever it might be, the equity, the rollover equity. But now I think, to your point, Michael, on the PE coming into the smaller firms, I've seen more of a pool of advisors who are saying, I could be that platform. Right? I'm not just looking to take my group and join something bigger. I'm not just looking for succession. To your point, John, you said this earlier, maybe like I could be that Carson of the future, right? I could go do that. Very similar to how our founder did it when, he kind of said, hey, I think I could do this better. I want to go out and do it. And I could see maybe PE finding and kind of, they're all betting on their horses of, okay, who has that ability? Now that takes a very unique type of personality to be able to be successful at that. But is that just me in the cheap seats kind of seeing that? Or are you guys starting to have those conversations with those advisors as well?
I would say the majority of our conversations cover that. So we always take a holistic, broad view, and we talk through what each of those options are and what are some of the pros and cons along the way. Oftentimes the risk tolerance isn't there. It's not you can have your cake and eat it too type scenario. It is truly a partnership. You are taking risk and you are betting on yourself. And to do that requires maybe a slightly different appetite. In particular, is most do not fully understand the value proposition that traditional private equity-backed larger scale players bring. They think of it as, I'm selling my business and that's it. And we're saying, well, no, you're taking some chips off the table. You're going to be taking equity in a larger entity that is well backed, that is growing at probably a higher rate than you are at at least into the long-term future. Well, you may have some short-term growth, but you will need to make significant investments. So it's about diversifying, getting into a larger entity, and then having an impact there and getting back to what it is that most truly want to do, which is serve their clients. They don't want to run the business. That's the majority of the firms that I deal with.
Yeah. We one of the themes at our conference just this last week was, and this was really neat, I think, for both Mike and I, is you walk around the conference floor and you see these firms that have transacted over the past, it'll be 4 years for me in January that I've been here. And, they're walking up and giving you a hug and shaking hands, and they all want to talk about the pipeline because all of these are equity holders. They are stakeholders in Carson, and they all want to talk about, hey, what's next? Like, what's coming? Who's joining the community? Yep. Who do I get to meet at Partner Summit next year? And what can I do to help? Because they know now that it's not just their performance that's driving the equity value higher, but they get to take advantage of our performance to drive that equity value higher. So we are a team now driving this thing into the future. And that's a hell of a lot of fun at conference, having those conversations.
It's a ton of fun. I wish I was involved in those conversations. I can tell you on the front end, when I'm selling a firm, and to see their eyes light up and they say, and when I'm communicating with them around the things that the acquirer is looking for, the things they're going to need to do, and how they hold that down on certain items and they won't move. And then when the eyes light up for the seller and they say, oh, I like this. This is the kind of firm I want to go with. If I'm going to be betting on their long-term growth, I want a firm that's going to be flexible to a degree, but they have to stand for something and have some level of value, and things they're unwilling to compromise on. They like that.
Yeah, I feel like too, for my firms that are, so I'm working with all of the Carson partners, right? And then a lot of times it's bringing them on into the wholly owned or minority. So they've already been here. They've been a part of the community. To Michael's point, I love going to Excel because for the ones who have gone wholly owned or they just did minority, now they have equity for the first time, it's that heightened level of engagement. But I think where Carson I think does really well is we celebrate and do all that in the open and together, right? We're very transparent about where we're taking this. How are we going to attract those next level firms? What kind of things are we doing, right? I have my serial acquirers who have done deals forever. I've helped them do deals. Now they're in the wholly owned, and they're wanting, okay, tell me about your latest deal. And we nerd out on deal structure. It keeps them kind of in that loop. So it's not just, oh, I have equity in this firm and it's a black box and I have no idea how it's going. It's, are you involved in that kind of community? Are we all getting excited together? What are we doing? I love those conversations. And again, to Michael's point, seeing the shift, because now they've got that ownership. They've got, some agency over what's happening, which is a lot of fun.
Yeah, Mike. Well, even at Excel, so John, you like every conference, you have the general sessions and then you do these breakouts. We had 3 M&A focused sessions back to back to back. And Mike and I were commenting, it's kind of like the same crowd in all 3 of those. Like the folks that are interested and invested, they come and they watch the panel of a few of our most recent, offices that have joined us. I did that macro level overview. Mike talked about volatility and how that may change deal structures and valuations. It's like the same crew that sits through all 3 hours of content. Those of us that love it, we love it.
Yeah, and those that have already gone through their own transaction, they're still wanting to just hear about M&A, be involved in it, right? What's the latest? How's it going?
Yeah. John, so let's, one of the topics that Mike and I talked about last time was just kind of like the basic anatomy of a deal. How are these generally structured? We realized, and we had a few of our listeners reach out to us, say, you guys talk about valuation, you talk about ideal outcomes, mandatory points of alignment, but you've never really kind of gone into what's a deal look like and how does it work? Was there anything that we mentioned just in the general sort of seeing the upfront component, the retention component, the growth component, and we talked a little bit about how those are measured. Was there anything in there that we talked about that maybe you disagreed with, or any nuances to what we talked about?
Yeah, so I didn't disagree with anything you said. You have your perspective, and we bring firms to you all the time, so you understand that we value that perspective. There are differences around the edges. So there's a lot of different ways to approach similar things around percentages of equity, cash up front, retention payments, 1 year, 2 year earnouts. Are they uncapped for a very short period of time or capped over a long period of time? And the thing that I appreciate most, that was just the conversation around compensation and the role that plays, and then aligning those incentives. And that conversation is something that we have to have with every business owner around, hey, you're very accustomed to making this much in income. We have to be careful how we say things around salary, because they pay themselves one way and then they're taking distributions, and that you have to look at that entirety and what are you living to, what aren't you living to, what does the future hold, and then understanding what an acquirer is paying for many things, but one of them is the cash flow. And how is that addressed? What are the replacement costs? What do they look like? And then also, how are you incentivized to grow? How do we align those things around earnouts and the like?
Yeah. When you mentioned earlier you said if we're retrading the deal, that's a bad thing. If we're getting down the road and we're retrading. So I would assume that, to your point there on compensation, a large part of your role is on the education on the front end, so they go in with full understanding of how this all works. The few times that I've kind of run into that retrading the deal, it kind of, you could trace it back to not a full understanding of one component of the deal, and getting down to the final minutes where we're signing documents like, whoa, actually, okay, wait, how does this going to work? So is that a large part of your process? And then how do you kind of talk them through the compensation component, how that changes before and after a deal?
Yeah, so we start early and often. We need to have an understanding of what everyone's making. We talk about how you're the equity holder, so you benefit from a reduction in compensation, but to what level? The replacement cost matters. The team members who are coming over who may not be participating, and we can talk about ways that we encourage our clients to allow for participation from non-equity holders, but the thing that's most important there is that this can't be a negative for folks. So we're looking for people to maintain and potentially grow through that transaction. And how do we set the pools up accordingly? What does that mean? And then how do you put yourself in a position where you're not coming over and then immediately having to draw down from savings in order for you to fund your lifestyle? That doesn't lead to happiness. And we have a saying that there's a nice sugar rush when that wire hits the bank account at closing, and then there's life after that. And the only thing you'll be working through is that life aspect of things. So we spend that time on their upfront to make sure that they understand that there's going to be a relationship here. There's going to be a need to have a replacement level cost in place. And also, your margin can only be so high, right? There's a level where there's diminished returns, or, hey, I could pay you 30 times multiple if you let me buy you at a 5% margin, and then I can just reduce comp after the fact. Like, we don't want that, right? Yeah. You also don't want me to show up with an 87% margin business. You say, that's great, John, we'll pay you 4x EBITDA for that because this is ridiculous. So we have to find that comfort zone where there's a little bit of tension, but where things work going forward for all parties involved.
I got that question in Phoenix this week, just around margin, and that's such a loaded question, because the answer is there's a band. Like it can be too high and too low. And both of those can be problematic for various reasons, whether it's this firm's not being run very efficiently, or this firm is sucking everything out of it and there is no growth to show for it. So that's I'm sure, a conversation you guys are having all the time. But it's a nuanced question.
The good news is typically those metrics tie together, right? There's something else. Like if you have extremely high margin, I want to go to your team and say, do you feel well compensated? Are you happy? Do you want to stay? I'm going to look at the growth rate. Are you investing back in growth? How has that been lately? Like, usually you'll start to see the margin or lower margin. There's questions on the other end, right? But usually there will be other things that tie out that you'll start to get an indicator of, is this truly just one of the best run firms I've ever seen that's the most efficient? Is this a new norm? Or is it, okay, it probably should be lower or higher in one way or the other?
Yeah, I agree. I mean, I think there is always some correlation to growth around margin, generally speaking. All right, 43 minutes in. At the prep call, I actually told John, I said, hey, this is something that the three of us do all the time. Like, we do this in our sleep. If there's a rabbit hole, we go down, chase that rabbit. That's quite all right. I will note, like 14 minutes in, we're talking YouTube influencers. So, Mike, well done.
You can count on me for a good rabbit hole. I apologize. That's always kind of
my
role.
That was perfect.
Yeah.
I learned something new, and I host this show with you. Yeah. All right, so John, two final sort of thoughts. One, I'd love for you to just give us like what's one of the most unusual or oddest quirks to a deal that you've ever seen, and then two, you guys have had some big news, so I want you to take advantage of the time that we're on the air here and talk about the merger that you guys have and the announcement that just came out this week.
Sure, great. So I'm not going to say, I won't say so much unusual, but I'll say interesting. So we were working at the firm for quite a period of time, and they were growing at a really rapid rate. They had equity across 3 generations, and everything was very well positioned for future growth. And they had very high conviction in their model, what they were looking to do and how they planned to do it. But then they began to look at the mechanics and the math of the money that they were going to take on and what that would mean for the senior partner and how long he would have to defer his payment. And the partners seemed to feel great about that. And they said, we think that we need to pursue a strategic partnership, but it has to be very specific. And we went through a pretty exhaustive process with them. And ultimately, the thing that was that made this deal very interesting was they were interested in upfront money for sure, and the retentions and all those fun things. But for them, the thing that was most important was around the earnout. What they were looking for was the ability to grow, but beyond the typical, hey, it kicks in at 5% through 15 or 5 through 20. They were adamant that they wanted to be able to receive benefit through 30% compound annual growth over a 3-year period because they believed that strongly. And it took quite a bit of convincing to go through this very large acquirer who had never stepped outside of that bound, but because of the conviction and the level of quality of the team that they were acquiring, they were able to get to that level. And for me, it was I wouldn't say I wasn't optimistic. I said, this is going to be a challenge going in. I said, I'm pretty sure that most firms have the things they're looking for, capital requirements. They need to make sure that they're well positioned. They don't want to have to pay on something that could just be market driven and not necessarily anything that you've done. I said, but I think that with the team and the level of involvement and the story that we have here, I think we have a chance. And we went down that path and we were able to get that outcome for the client. And for myself, Rob, and Kim, when we closed that deal, we felt like, wow, this was something that was truly different from what we've done in the past. And by all accounts, now they're a couple of years in-ish, and everything is hitting on all cylinders for them. So it feels like it's been a win-win so far.
Yeah, good for them. It's funny, in our last episode, we talked about this. So we have an opportunity that's going to close here in about probably 2.5 weeks. And I referred to them as a force of nature. And that's what they came back to us on. They said, you've got this capped at 15%. We want it up to 20. That was the easiest thing to say yes to, because this team, we believe so highly in growth. I'd be shocked if they don't hit that. So from a firm perspective, that I think is probably the easiest thing to negotiate for Carson. We love that question of what happens if I do 16, 17, 18% CAGR.
I'm making the mental notes sound like one.
Well, yeah. You can hold me to it.
Yeah.
All right. You want to talk about your big news?
Yeah, sure. So very excited to announce, it was announced earlier this week that MarshBerry has entered into a partnership with Lincoln International. And this is exciting for a lot of reasons. Lincoln International is a massive global investment bank. They operate in a way that's very similar to MarshBerry, where we like to think of ourselves as a boutique firm with institutional capabilities. And this is the opportunity for MarshBerry to plug directly in and fill a gap that, quite frankly, Lincoln doesn't have today. So we're complementary to what they're doing in insurance brokerage and in wealth advisory. So we're going to maintain the MarshBerry brand. We're going to do all the things that MarshBerry has done. We're going to remain the same operating model. We're just going to do it with even more resources and more capabilities behind the scenes. We're super excited about it. And I think I said as on my LinkedIn post, the future is bright. And I still feel that way. I'm looking forward to what the future holds.
Yeah, congrats. I remarked on LinkedIn that obviously good M&A is about the people involved, not in the assets, not in the cash flow. And I mean it. Lincoln International just scored an absolute just home run with getting you and Rob and Kim. So well done. Congrats to that whole team.
So thank you very much. Appreciate it.
My pleasure. All right. Any closing thoughts? Mike, anything we didn't address that we were supposed to?
We could keep talking about the YouTube M&A space, but I think we could save that for
I
a separate episode.
I need to brush up on that. That's our next market.
Yeah, there we go.
John, thanks so much for joining us. Really appreciate the time. I know you guys are super busy. You had a banner year. You in particular are responsible for a lot of the thought leadership and the writing and the research that comes out from MarshBerry. So please keep that up. That's something that Mike and I rely on. We use that quite a bit. So thanks for taking the time to join us on Know Your Worth. Really appreciate you having you here.
Mike and Michael, thank you very much. And then one last plug. So yes, I am responsible for a vast majority of the content that comes out. But I will leave you with this: the team. There is a massive team behind me that enables me to be in 100 places at once, quoted everywhere, and just at top content, and then to be able to sit on a podcast like this. So truly blessed to be in an organization like MarshBerry, and looking forward to continuing to make it international.
Hey, I've remarked before, Kyle in particular. You've got some young talent on that team that we view as an up and comer. So you guys have hired well.
Hell, thank you very much.
All right, guys, have a great day.
Thanks, guys.